Let me go to a single best chart right now. We showed this moments ago. It's an approximation. It's Saudi light, adjusted for inflation and rising Western world incomes. And the bottom line, the story of it is after OPEC 86 and all that, you know what, we're back to the 70s almost as well. All of this then is around the cliche and taking Exxon as the example of it's a financial thing that happens to do oil. Is that still true, and will it be true in the future, that these are nothing more than financial companies that happen to be doing hydrocarbons?
No, I don't think so anymore. I mean, I think that was very much Exxon's reputation through the 80s and into the 2000s, when it was very much a financer of mega projects. Now they're one of the biggest, in fact, they are the biggest growth play in the Permian. And that's very much about technology. That's all about horizontal drilling and fracking, and productivity gains, which is a huge part of what you're seeing on your chart.
What does the greater Middle East and all of our stereotypes of the prize, Jürgen's the prize, what do they do about that technology metric you're talking about?
It's a challenge, and what OPEC is doing right now, led by Saudi, is Saudi's now under 10 million barrels a day of production. They've shown that they have the capacity really to produce 12 million barrels a day. So essentially they're being forced by the US E&Ps in order to balance the market to go to really quite low levels of production relative to capacity.
Paul, how much do we understand actually the complexity of shale oil in the U.S.? We have a great story on the Bloomberg terminal basically saying that some of the Asian refiners are turning it away because there may be some metal components. Is that something that will become bigger? Do we even understand, you know, if there's an average price at which they can break even in the U.S. shale oil?
Well, you know, now the companies are talking about $40 and below for break-even, but this is such an incredible revolution that we've seen here in the U.S. that obviously there's going to be some teething problems. You have to recognize that we've only just started exporting oil in the past couple of years. Now we're exporting 3 million barrels a day. And in the process, given, as I said, you know, it's so new, you're going to get some teething problems that, you know, really aren't that big a deal against the mega theme here. Thinking the way Tom thinks, which is to go, you know, back over a 30, 40, 50-year cycle, really is how long it is since U.S. production was growing in terms of oil. So, you know, I don't think, yeah, it's interesting on a short-term micro basis, but the mega theme is overwhelming, and it's strong dollar. You know, it's very dramatic, as Tom's highlighting, for the Middle East. It's really time to think big about some of these, the scale of the shift that we've had here.
But Paul, is it more difficult to refine some of this U.S. shale oil?
No, it's lighter and sweeter. So essentially it has lower sulfur and breaks down with less heat. The issue is that the industry spent the past 30 years planning for heavier and sourer oil. Yeah. So the fact is that, you know, we're in a situation where suddenly, especially with the really quite sudden sanctions on Venezuela, notwithstanding the secular decline in Venezuela, suddenly there's just too much light sweet for what the global refining capacity was expecting. Again, that's not that big a deal, because essentially you can turn a heavy sour refinery into a light sweet refinery. You can't turn a light sweet into a heavy sour. So, you know, the general metallurgy and all the other issues are in our favor. It just takes a bit of time. And the capital discipline of the refiners, the cash return strategy of the refiners, means they're actually being slow to respond, because, you know, they don't want to just spend a ton of money and find out for some reason that we don't have as much light sweet as we thought, which is what happened to the heavy sour.
Long ago and far away, there was a guy at Bear Stearns named Lawrence Kudlow. I believe he's at 1600 Pennsylvania Avenue.
I've heard of him, yeah.
And Larry would make a big deal about the lifting cost of oil bringing us to a perfectly competitive microeconomics. And then it was $9 or $10 or $11 a barrel, whatever it was, a million years ago. What's the blended lifting cost now that establishes the Sankey microeconomics that are out there?
I love this. So basically Saudis is the same or lower. So that would be in the $3 or $4 a barrel. And in the shale, it's more like 20, basically. So
we're back up 20 or 30.
Yeah, it's higher. I mean, it's higher. These are wells with high decline rate, many more of them. Yeah. You know, essentially lower long-term productivity, but also a much shorter investment cycle. So the main change here is that whereas previously you were forced into projects that were 30-year projects, now we've got 90-day projects and 6-month full cycles. Well, I should say half-cycle type economics. So it's a very different thing.